If you're like one of millions of people in United States and have a higher education, chances are really good you have student loans. And if you've been paying any attention whatsoever, you probably have heard that there's a lot of changes coming in 2026 when it comes to student loans, both in the borrowing and repaying end of things. And if you have student loans or are thinking about potentially getting them, this episode is for you. Hi, everybody. Welcome to Elephant Corner Financial Lab. My name is Nev Kraguljevic. I am a financial advisor and financial planner with Elephant Corner Financial. And in today's episode, I really want to focus on talking about student loans. One of my big passions is to help individuals and help my clients with their student loans. Challenge, and this is a very heated topic. I'm not here to talk about the politics. I am really here to actually just help you make sense of your student loans. And it's one of the most heated topics I have ever heard of, inside the world of finance, outside of the world of finance. Wherever I turn around, people seem to have a lot of opinions about it. Whatever your opinion is, it's completely valid. I'm not here to argue. What I want to do is help you figure out what are some of the options, what are some of the changes, and really help you like navigate this whole thing. So, as you've likely heard, in July of 2025, uh, new law came to be. One big beautiful bill was signed into law in July 2025, and that particular bill talks about a lot of things, but one of the specific pieces that it focuses on are student loans, specifically with many different income-driven repayment plans going away and only one kind of coming back, one surviving. So let's break it down. Let's talk about it, and then we're going to look at the example to kind of see what the impact is, because one size does not fit all in this scenario at all. So first thing first, save, repay, ICR are going away. Out of the old or legacy or traditional plans, IBR, income-based repayment plan, is the only one that will survive, and it only survives for folks that will have loans prior to 2026. If you get loans in 2026, in July 2026 and beyond, IBR is not going to be an option. So I'm going to divide this into a couple of different categories. One of the categories is if you are a borrower right now, or you have student loans right now, you're done with school, you graduated, you just have student loans, and maybe you were on pay or save plan. A lot of people are in save plan. You are in forbearance right now. Now that we're recording this is basically end of January 2026. You're going to see it sometimes in February, hopefully, in 2026. But it's in the forbearance, and so you have a few years to switch. Your options are going to be standard repayment, I'll explain, new wrap payment, I'll explain, and IBR, I'll explain. Okay, so if you are current borrower, as in you already have loans. If you, well, if you are watching this and you don't have loans yet, that means you're in high school, and bravo for being here. But chances are you're probably a parent of a high school student who is about to go in and you're trying to figure out them borrowing. So if they don't have loans, meaning they're in high school, they're going to start college in fall 2026 or beyond. If they're borrowing, the only options for them are going to be standard repayment plan or the new wrap. So now let's talk about what are these payment plans? How does it work? Let's break it down. So standard repayment plan is what you get when you graduate and don't select anything. They automatically put you into standard repayment plan, and it works just like any other loan. It's 120 payments, as in 10 years. The amount divided by those 10 payments, and you pay off the loan in full. That's basically what it is. It's akin to borrowing money for a car, right? You go in, you borrow money. There's no forgiveness involved. There's no income calculation involved. It's just the standard repayment, just like any other loan. That's what standard repayment is. Now, if you decide that you want to take advantage of income driven plans, IDRs, and big old umbrella, then you have a couple of options, and you'll have only a couple of options for a moment. And again, if you're in your borrower, you only have one option. So IBR, income-based repayment plan, is going to be one of the options for folks that currently have loans. And of course, why make it simple when we can make it more complex? There are two different versions, two different flavors of IBR plans, if you would. Old and new. And which one you get, it depends on when you first borrowed for student loans. So if it's pre-2014, you'll get the old. If it's post-2014, you'll get the new. And the difference really is in the number of years that you have to make payments before any amount is forgiven. So old is 25 years, new is 20 years. And also in the amount of discretionary income that is going to be used, which is going to be 10% or 15%. Right? The new is going to be much more favorable than the old, but old could potentially work for some folks better than the standard. We'll take a look at examples. Just want you to understand. And what is discretionary income? So basically how all of the income-driven plans, they focus on AGI, adjusted gross income. And they will take AGI, they will take a federal poverty level, which changes every single year. So for 2026, the federal poverty level for a single individual is $15,960. If you're a family of two, then you'll add $5,680 per person, right? So if it's two, it's just $5,680. If it's three additional people, then you'll say $5,680 times three to be able to calculate. That's how IBR is. They will basically protect a portion of the income and then apply that. That's how they derive to the discretionary income. Then apply that discretionary income percentage on annual basis, then divided by 12 to get your monthly payment. That's how IBR works. RAP is the new or the newest program that is coming in. And is going to be available for the current borrowers and those that are going to be first-time borrowers in July 2026 is going to be the only income-driven repayment plan, and it stands for Repayment Assistance Plan, RAP. It's going to be available in July of 2026, so we have a few months, but I kind of like to plan in advance. I mean, I'm a financial planner, what can I say? So what is that? Well, it also focuses on AGI, but instead of taking the federal poverty level and excluding a portion of that, this one doesn't do that. It basically takes the entire AGI and then applies a percentage. So if your AGI is $10,000 or less, your minimum payment is going to be $10. $10 a month, that's what you're going to be paying. And you're going to be paying that for 30 years. That's what the new RAP is. So IBR is 20 or 25. RAP is going to be 30 years worth of payment. So it's entire AGI, and if you start making income of 10,000 or your AGI is 10,000 and $1 up to 20,000, then you'll pay 1% of income. 20 to 30 is 2, 30 to 40, and so on up until $100,000 and above, at which point 10% of your income is going to count towards your student loan repayments under RAP. So those are the rules. Now, the question that a lot of folks have is like, how does that actually work in reality? So I have prepared an example, and because there's a lot of moving parts, there's a lot of calculations. I've actually prepared this, so I hope it's okay in the effort of time. I've prepared this, so let's take a look. So here is our example. We have a single individual. We're going to assume that the AGI is $60,000 and the amount of student loans is $120,000. Now, for income-driven repayment plans, the amount owed actually doesn't matter. Well, it matters because you want to know how much you need to pay off, but it doesn't matter in the calculation of how much you need to pay. Where the amount owed really makes a difference for us is calculating the standard repayment and also understanding like how much will you be paying more or less under different plans. We're also going to assume a couple of different things. We're going to assume that you're going to have an interest of 6.5% on those loans. Now, I'm going to zoom out a little bit, and there are going to be some payment options. So what are our payment options under this scenario? So payment options are standard, which is going to be $1,361 a month, so $1,361 per month. The new wrap is going to be $250 a month, and the IBR is going to be, depending if it's new or old, either $300 to $450 per month. Now, if we were to just look at this on the surface, then it would be very obvious that the wrap wins this race, right? 250 is way less than $300 and $450, and absolutely both are less than the standard repayment of $1,361 per month. But then the question that I had, wanting to explore, because it's important to understand and not just take it on the payment, we need to look at the whole piece, is to say, well, when would this be paid off, or when would be forgiven? So under the standard, we're going to be done with student loans in 10 years. Under the wrap is going to be 30 years, and then under the income, the IBR is going to be 20 to 25 years, right? So that's kind of how this is going to play out. Then the question comes in, all right, well, what is the total amount that we've paid under each scenario? And here's where it gets a little bit interesting. Under the standard repayment plan, the total amount that is going to be paid back, which the loan is paid in full by then, is $163,000. Under the wrap, over the course of 30 years, you'll pay $90,000. And under the IBR, you'll be paying $72,000 to $135,000. Now, we are also assuming that your income / AGI remains the same for the duration of 20 to 30 years. Probably unlikely, but we have to assume something, right? And we're assuming that the situation doesn't change in your life in any way, shape, or form. So while we started with the wrap being definite best option, now we're actually seeing that IBR could potentially be a better option if we are able to get this lower end of the spectrum, where over the course of 20 years you actually pay off 72,000 as opposed to 90,000, right? So that's another way to look at it. Then I said, well, what happens if the borrower gets married? I mean, it's not unusual. People do it all the time. And we're also going to assume that the spouse doesn't have any student loans, because if they did, the rules change completely all over again. So under the standard repayment plan, no changes, $163,000. Under the wrap, no changes, $90,000. But under the IBR, big changes. Now we're looking at potentially $55,000 to $103,000, depending if it's a new or old IBR. Now, again, assumption is that the AGI hasn't changed. So I guess you married somebody who's right, like you either have lower income or their income is not affecting yours at all. So that's another way to look at it, but it was just trying to do different scenarios to let you start thinking about this differently, that it's not that simple of a math and simple of an answer. Now, what happens if, say, you're married and have kids and your AGI is $60,000? Okay, now the math changes one more time. And I think you'll be shocked to find out how much it actually changes. So married with two kids, right? Married with two kids. Under the standard repayment plan, again, nothing changes, $163,000 over the course of 10 years, and you're paid off and done. Under wrap is going to be $90,000. 30 years later, whatever, is that's you paid $90,000. And then under the IBR, married with two kids, now we're looking at 21 to, let's round it up, $40,000 over the course of the payment period. That is a huge difference. So all of a sudden we went from wrap is the best to, I don't know, IBR might be the best. I'm not quite sure, because as the situation changes, the rules don't necessarily change. What changes is how we're calculating these things, and what is changing is that the math ends up shifting potentially in your favor. More dependents you have, so larger family you have, lower the AGI, and ends up shifting things. Now, because we're here in lab and we like to explore things and sort of ask questions and say, how does this apply to different scenarios? I said, well, what if instead of AGI being 60,000, what if AGI is 120,000? So 120,000 AGI, 120,000 worth of student loans. Let's take a look. Okay, so again, AGI, 120,000. Payment options, we have standard, wrap, IBR. Again, standard doesn't change. It's $13.61 per month. Okay. Wrap changed drastically. It went from $250 a month under the 60K of AGI to $1,000 a month with 120K of AGI. And IBR also changed drastically. It went from 800 to 1200 a month, depending if it's a new or old version under the 120K. Now, again, the payoff is going to be the same. It's going to be 10 years, 20 years to 20 to 25 years for IBR, and then 30 years for wrap. But one of the pieces that I wanted to find out is, how does this change in the amount that we're actually paying? So total paid under the standard is, again, 163,000. Doesn't change at all. Under wrap, now we're talking $360,000. And under IBR is, again, anywhere between $192,000 to $360,000. So again, we went from one is absolutely the best to now things are shifting, because $163,000 under standard repayment is way less than either wrap or IBR for that matter. And matter of fact, I haven't calculated this, but I feel fairly confident to say that, well, I mean, we can see it right here in this, is that, you'll actually pay way more trying to quote unquote save money with income driven plan than just paying off the student loans. So here, assuming single, assuming AGI of 120, it almost becomes a no-brainer that you're better off just paying off your loans, as painful as $13.61 a month might be. Now, the question was, well, what if married, right? Because as you know, the IBR will change based off of that. And here is what we have for that. Again, 163 for standard, 360 for wrap, but 175 to 328 under IBR. Again, standard repayment does definitely come much better off, but IBR is pretty close. Now, if we were to assume that you have a family, right, you're married and have 2 kids, so family of 4, assuming only one spouse has student loans, and AGI is $120,000, here is what it actually looks like. 163,000 under the standard, 360 under wrap, and now we're looking at 141 to 264 for IBR. So IBR could be a pretty darn good contender here. So what have we learned by exploring these options and talking about this? Is that some of these plans are going to work for some people and are going to be horrible for other people. If you're only focusing on that monthly payment, you might be missing a bigger picture where you'll overpay over the course and lifetime of a loan. So you want to calculate both. You want to calculate your monthly because that cash flow is important. You need to be able to eat and pay for housing and, like other things in life. And if you have kiddos, like, they need to eat and school. And I mean, they don't come for free. Unfortunately, I wish they did, but they don't. Kids can be very, very pricey to the budget. But you don't want to focus just on the budget, and you don't want to focus on the big picture. You kind of need to look at the both components here. You also want to think down the line into the future. Because, for example, rap, if you get into it, once you sign up for it, you sign up for it. That's that. Like it's a lot of these things within student loans are sort of like a one-way doors, right? Like you can, it's like a Hotel California. You can go in, but you're never coming out. So you want to be very, very careful to actually think through of, is there a potential that my income will change drastically? Because most of us, when we get in and we start working, our income is typically the lowest that it's ever going to be. As we progress in a career, as we get more experience, maybe even more education, and move on up, our income tends to go up and explode. And so you definitely want to pay attention to that. Will your income increase significantly over the course of 30 years? I would argue for the vast majority of people, the answer is going to be yes. But again, I can't answer that for you. You're going to have to answer that for yourself. The other things you want to think about is, will I potentially get married? Will I potentially have kids, whether you get married or not? Will there be other dependents? Because it's not just kids. Under the income-based repayment, it's the dependents, it's the size of the family. And so, will potentially your parent become a dependent, or your sibling become a dependent upon you? So there's all these life situations that I think are worth exploring. And this is one of the very, very complex pieces that is shifting. If you get married and your spouse also will have student loans, then the math changes altogether, right? And so now we have to brand new calculations that I haven't prepared here for you, but just wanted to compare apples to oranges, because they really are apples to oranges. It's all fruit, but it's very, very different fruit, and you might be allergic to one of them for all I know. So the idea really is to think through your current income, think through your future income, and think through your current and future family situation and status before you make a decision. One of the things that I would suggest, and I feel very comfortable actually suggesting this, is please talk to a financial planner, and make sure you find a financial planner that has student loan expertise and certifications behind it to understand the moving pieces within it. It is a specialized niche certification that one has to get. I'm excited to have it. It went in for a reason. That maybe I'll share in a different video. But make sure you find somebody who understands these, that can help you plan for not just this, but other moving pieces as well, to help you decipher of which option is the best option for me. Because one option we didn't talk about is potentially refinancing with privates, but that also comes with a risk. So it shouldn't be a simple, easy piece to decide on or decipher. So here you go. Hopefully this answered some questions and probably raised 10,000 more questions. It would be impossible for me to try to model every single iteration of what is possible and what is out there, but really wanted to raise your awareness to say, hey, if you have student loans, or if you will be getting student loans, or if somebody in your family has or will be getting student loans, please pay attention. A lot has changed, and a lot will be changing in the months and years ahead, and you definitely want to start planning now and shifting things. One final piece I want to mention before we go away is that if there's any amount of student loans that is going to be forgiven, so say for example you had 300,000 worth of student loans, and if you are sitting there shocked like, do people really have that? Yes, a lot of people actually really have that. Worked with clients who have well over $500,000 worth of student loans. These things can be huge and can balloon. So let's assume that you're under either RAP or IBR, and you're paying and your loans will be forgiven. The amount that is forgiven, unless it's for the public service loan forgiveness, which both RAP and IBR will count towards, so PSLF, unless it's that, whatever the amount forgiven is going to be seen as taxable income to you in the year that is forgiven, which means a much larger tax bill. So while many people focus on the forgiveness only, sort of like a public service announcement, please start paying attention and planning for that future tax bill. Start saving today, maybe. I don't know, crazy consideration. Plan in advance, plan for the future, so that when that forgiveness, it really feels like forgiveness and it feels like time to celebrate, as opposed to, well, this was short-lived because now I owe IRS as opposed to the Department of Education. So let's make sure that that doesn't happen to you. Plan in advance. And again, if this is too much, and it is a lot for sure, please work with somebody who knows what they're doing, can help you out, guide you, answer questions so that you feel set and you know what to do and what works for your specific situation. Thank you so much for watching. If this was helpful, give it a like, give it a thumbs up, give it a subscription. I don't know. And tell other people. And I look forward to seeing you in the next video. Until then, stay money blessed.